Hello everyone, this is Aryan and welcome back to Stock Market University. So in today's video, we're going to be looking at two indicators within the same video. This is because these indicators are not too complicated. We can more easily understand them, and so we're not going to give them too much time. These are the average directional index or the ADX and the moving average convergence divergence, which is the MACD. We're also be gonna looking at how to use both of these indicators in combination, just because since they're already in the same video, just pack that in there as well. So this is going to be the first video in our series where we look at combination strategies, where we combine multiple indicators, and these are going to get more and more complicated and hence I think more and more useful as well as we go on with this course. Without further ado, let's get started. First of all, we'll go to the indicators here and add the ADX. Just type in ADX here, average directional index. Now what we're going to do, as explained in the first video as well actually, is go on to the ADX here, click these three dots for more, and add an indicator on top of the ADX. What you're going to add is the EMA, the moving average exponential, this one right here. Now what you'll do is head on to the EMA and change the settings. Change the settings and change the length there to 70. Now the blue line here, of course, is the EMA and the red one is the ADX. The main idea here behind ADX basically is whenever ADX is on the higher side of its average, the average of 70 iterations of the ADX as we're looking at here because of the 70 EMA. You could use other numbers whichever suit you, but through my testing and experience, this one is what's given me the best results. 70 EMA, that is, I'm talking about. So basically, whenever the ADX is above the 70 EMA, that's supposed to signify that whatever momentum is already happening in the market, say if the markets are going down and the ADX is above the blue line here, it's supposed to continue going down. The momentum continues. And as we can see here on the chart, we'll see now ADX crossed above the blue line, the EMA here, around this point according to the candles. And there was already, you'll see, hold on, let me draw this out for you. You'll see there was already bullish momentum before this crossover of the ADX and the EMA. Right? There was bullish momentum beforehand, and then it continued with an increasing pace after the ADX had crossed over. You can just use this indicator really to add to your convictions and be sure that the trade you're entering into is not going to be one of those where you see momentum generating, you enter a trade, and it just doesn't pay off. You keep sitting in it and eventually just exit close to your price or even in a loss sometimes. Because momentum in markets is very important when you're trying to, especially if your time span isn't way too long. Like if you're looking at multiple years for investments, indicators like the ADX wouldn't be too much use to you unless you're looking at them on a monthly chart, of course. Then it could be, but not too many people do that, I don't believe. Now, that's one example for the ADX. Let's try to look for one on the downside as well. It's the Dow Jones Index. Here we have one. So ADX crosses over here, goes above the little EMA line. Momentum before this was bearish momentum was forming, and afterwards, of course, bearish momentum continued while ADX was increasing. Now, ADX also is useful for knowing when to exit positions. Say if you want to use the same strategy and you don't want too much clutter on your chart, you just want to use the ADX and maybe one or two more indicators like the volume or the RSI. What you could do as well to exit your positions is go to the ADX again, the three dots, add another indicator on top of it. This time it's going to be the EMA again, but you leave the EMA at 9. You don't change any settings this time around. Let me change the color though, so it's more easily visible. So this white EMA now is the 9 EMA instead of the 70 or a longer time period. So when you were in this trade, you took a short around here, right? Because ADX was crossing up, you saw bearish momentum forming, and of course, lower lows and lower highs forming as well, which is bearish price action. You were in this trade and you saw price kind of bottoming out, flattening out, the momentum starting to decrease, curving out here, as well as the ADX crossing down below its short term, which is the 9 EMA. Crossing below the 9 EMA is basically suggesting that for now the momentum's done for. And this is a good opportunity to take an exit in the trade without losing too much of your profits when it starts going back up, right? So that's another great way to use the ADX with two EMAs on it, one long term for starting the position and then the short term one for exiting it. I'll hide the 9 EMA for now. Right. Now the second indicator we're going to look at today is the MACD, the moving average convergence divergence. Now what this basically is, it's depicted as these two lines. Look at these two lines, the blue one and the orange one. Now MACD, what it basically is the relationship between two different moving averages, as you can tell from the name. And what this relationship between the two averages tells you, it's basically you can interpret it like the EMAs we talked about a few videos ago as well. When the smaller average is above the larger one, the blue one is the smaller one in this case. Whenever it is above the larger one, which is the orange one, there's bullish momentum, and vice versa. When it's below the orange one, like it was here, there's bearish momentum. Now you can't really see too much happening here, which is why you need other indicators such as the ADX as well to confirm whether you want to enter trades or not. See, MACD was going down here, so it suggests a short trade, but ADX was also going down, and as you can see here, it was also below this white line here, the 9 EMA. So there was no trade in the making really, because the momentum wasn't there, only the signal was there from the MACD. So, and these histograms on the MACD as well are a good signal in case, some people like to interpret the MACD from the histograms, others do with the blue and orange lines there, but it's really up to you, whichever one you want to do. As for interpreting the histograms, what you do is when they start getting smaller in size in either one direction, see, green bars were increasing here. Let me draw this. Green bars are increasing. That means bullish momentum carries on. Soon as one and these dark green bars means that the size of them are increasing. As soon as we get a light green one or this whitish one here, that means it's smaller than the previous bar, which is sign for the top approaching. And once there was this final buyout candle, we started seeing white bars and the bullish momentum in the share died out. This, of course, we can check here if this coincided with the ADX as well. As you can see here, the top was created around here. Let me draw a horizontal line here so we can see what I'm talking about. Sorry, a vertical one is needed here, right? So this vertical line, the MACD is shown a top out here according to the histogram. You'll see here the crossover happened later on around here. So the histograms actually are leading indicators because they show what kind of gap there is between the two EMAs, the two moving averages used to calculate the MACD is basically what these are, the histograms. And of course, the histograms work in the opposite direction when they're red. But as for this, what we're talking about here, as you can see, even the ADX gave the signal to get out of the bullish position a little later on. The first indicator really to get the exit signal was the MACD itself. So that's again something to really look at if you're considering, especially trading on shorter time frames, such as maybe on a weekly, or even if you trade trades for multiple weeks, you'd want to look at things like this, especially as you get to shorter time frames like intraday. You're taking a trade for 2 hours. These things get more and more important as we approach those levels of intensity in trading, really. So that, of course, friends, is MACD and ADX. I'll shut down the ADX for now and just talk a little bit more about the negative side of MACD because I haven't done that yet. You can see here when the blue line crossed below the orange line here, we saw the start of the red bars and price started moving down. I believe ADX or volumes wouldn't have been too good because we didn't really see continuing price action in the same direction, but the histograms did increase in price for a bit. Small move here, but as soon as the white one was made, even though the line still did not cross back over to the positive side, the histograms turned white. So we'd take an exit there, and that would save us from facing bigger losses later on. So yeah, keep an eye on these histogram, guys. If you want to use the MACDs, those are really helpful for exiting trades again, and even entering them if you're trying to be more cautious. But you could enter them a bit beforehand with by using the lines instead of the histograms in convergence with ADX volumes, stuff like that. And the more indicators you use, the more solid your convictions will be. And of course, using too many, like I've said before, also can be a hindrance if you're on your chart and you can't even see the price. All you see is like 17, 20 different indicators on there. That doesn't really work out either. But yeah, that's it for the MACD and ADX, guys. So we'll end it here for now. Thank you guys for watching, and let's continue learning together. If you did like this video, please do like and subscribe.